Dear students, we will do module 65. 65 is about section 54G, exemption for capital gain. Now what is section 54G? 54G is capital gain on shifting of industrial undertaking from urban area to non-urban area. Say for example, now the Karnataka government, they are struggling to control the traffic in Bangalore city. Everybody is complaining about that. So what they have announced a new scheme which all industrial areas which are situated in urban area, they'll transfer to rural area. Lot of incentives government is giving. Similarly, many governments will announce like this. So this section 54G will be available for them if they are shifting their industrial undertaking from urban area to rural area. So rural area also people will get job, they will development will happen. That is the advantage. Now what are the conditions? Following conditions are to be satisfied then to get the capital gain exempted. First is a capital asset. It can be plant and machinery, land and building, or any right in the transport due to shifting of industrial undertaking from urban area to rural area. Any transfer due to shift, any right in the property, meaning it can be lease also. The building has taken on lease or machinery has taken on lease. That they are shifting from urban area to rural area. This exemption is not available for furniture, we have to remember. All other assets possible, but for furniture they are not giving this exemption. Now what is the condition? Capital gain, whatever they are getting, they should reinvest within a period of 1 year before or 3 years after. 1 year before, 1 year before or 3 years after. See, this I have explained when we are buying a house property also. See, it's not a small investment. When you have to invest a huge amount, what you will do? When you are when you have decided you are going to shift, 1 year or 2 years before itself, you will plan where to invest, how to invest. So that planning, sometimes you will identify somewhere a place in rural area, a building in rural area. You will make some investment for that. So that is how it is 1 year before or 3 years after this shifting will happen or that capital gain is erased. So they will get a time for 1 year before or 3 years after the transfer of such assets. See, purchase of new machinery or plan for the purpose of business to which the said land undertaking, this has to be shifted to the new industrial undertaking. That is the condition. Now it can be by acquiring land and building, or shifting the entire industrial unit to the new venue or to the new place, or any other expenses. See, shifting an industrial unit is not a small expense. The transportation, the all the expenses, whatever the government will have allowed them, they can incur that. Now, specified purpose, the purchase of machinery in the area which is said under, see that always we have to remember the entire industrial unit is shifted from urban area to rural area. So the process will continue, industrial activity will continue and rural area will get the development. Now amount of exemption. What is the amount of exemption? Whatever capital gain arised, then you have to invest that amount fully. If you are investing, you will get exemption under section 54G. If one part is not invested, then you have to pay the tax for that. So that is the treatment. And now the what is the consequence? So consequence is 3 years you have to keep that. Lock-in period is 3 years. Before 3 years again, if you're shifting, whatever the consequence I will tell you. See, already you got either short-term capital gain or long-term capital gain exemption. Plus, within 3 years, if you're selling it, you will again get one more capital gain. If it's within 2 years or 1 year, either long-term or short-term. So, both will be taxed. That meaning, whatever exemption claimed earlier would be withdrawn and the new capital gain and the exemption you claimed earlier will be taxable. Now one problem we will do. The problem is Mr. P and Messrs. P and Q Bangalore were running an industrial unit, were ordered by the government to shift their unit to rural area. They had shifted their unit in the previous year 24-25 and sold some of their assets for shifting. The details are given in the table given below. Compute the taxable capital gain for the assessment year 25-26. CII for 2003-4 is 109, 2006 and 7 is 122 and 24-25 is 363. Now Four assets are given. One is plant and machinery, land, building, furniture. You have to remember plant and machinery, building and furniture, they have given the written down value. So the condition you have to remember, if it's written down value, it's always short-term capital gain. Now sale proceeds are given and only one land you have to do the indexation because the it is acquired in the year 2003. So land you have to convert it into index cost and you have to calculate the capital gain. And amount invested is also given. Plant and machinery 8 lakhs, land is 2 lakhs and building is 5 lakhs. So total 15 lakhs he has invested. Now we will do the calculation. See plant and machinery, it is short term capital gain because written down value. Then land, then last is furniture and next is building. So building. So four assets. So three we are getting short term capital gain. First one, plant and machinery 10 lakhs is the sale proceeds, 10 lakhs. 10 lakhs and written down value is 4,40,000. 4,40,000. So all these three are short term capital gain. This is 5,60,000 short term capital gain. 5,60,000. Land we have to index. Building is 12 lakhs sale proceeds. 12 lakhs sale proceeds and the value is whatever written down value 7,32,500. 7,32,500. So short term capital gain 4,67,500. Now for furniture the value is 2,15,000. Furniture you have to remember exemption is not available. 2,15,000 and 1,05,000 is the written down value. So the short term capital gain is 1,10,000. Now for land you have to index that. Sale proceeds is 10,90,000. 10,90,000. Now index cost is, the value is 3 lakhs into 363 divided by 109. 109. The value is 9,99,083. So long term capital gain in this case is 90,970. Now total capital gain we have to calculate 5,60,000 and 4,67,500. See furniture it is not available. So here you have to remember 15 lakhs they have invested. Furniture they are not getting the capital gain exemption. So all the short term capital 5,60,000, 4,67,000, 1,10,000 and plus long term capital gain 90,970. So when you take up the total you will get 12,28,470. That is by adding these four values. So this is but they have invested 15 lakhs. So they don't have to pay any tax. And one thing you have to remember, for furniture, this section or exemption under section 54G is not available. So this is what I wanted to explain in this module. Happy learning. Thank you.